Hey folks, welcome to a portfolio review at Finominal. Today we're going to look at Fidelity's sector equity business cycle model. Now, Fidelity is known for its bench of fundamental analysts that have deep sector expertise, knowing management teams, covering companies for years, even decades. So let's see if Fidelity can use that sector expertise for its sector rotation strategy. Now, if you look at the portfolio, we do see that this is comprised of, I think it's around 11 funds and ETFs. They're all from Fidelity. And we see there's an overweight in tech with 30%, financials with 20%, followed by consumer discretionary with 17%. If you look at the fact sheet of Fidelity's model portfolio, we do see the Russell 3000 as a benchmark index. And that's actually the same benchmark that our tool is suggesting. Now, if we take the current holdings and look at the performance of those versus the Russell 3000, we do see a significant outperformance since 2020. Now, we got to deduct this or discount this to be precise, simply because what tends to happen is that fund managers or model portfolio providers tend to chase performance like everyone else. So usually the current holdings always look better than the benchmark. And so to a degree, we can kind of like disregard that outperformance because it's not the actual track record of the portfolio. It's simply the performance of the current holdings. Having said that, we can look at the fact sheet. And what we do see is here we see the Fidelity sector equity business cycle model. And let's go to the 5-year returns. So we do see over 5 years, this generated 16.94%. Now that is a gross return versus the net return is 13.47% versus the Russell 3000 that is 15.96. Now they're deducting this 3% advisory fee, which seems somewhat large for an advisor. Usually it's like 50, 75, 100 basis points. Having said that, this is also before brokerage fees, custodial fee, platform fees, and so on. Now, stated differently, right? And if it's implemented a financial advisor, there will be a fee. So effectively, Fidelity, if you deduct transaction costs and custodial fees and platform fees and so on, right? There's not a lot of, if any, value left through the sector rotation strategy. So that's actually not that great for Fidelity. Now, if you look at a little bit more in depth in this portfolio, what we can look is at the current sector exposures versus the Russell 3000. And what we see over here is that there are some similarities. There's some similar amount in technology stocks, but there's also some significant differences. There's currently an overweight in consumer discretionary, in financials, and we can see there's a significant underweight in healthcare and industrials. If you look at this from a stock level, we can see there's overweights in NVIDIA, Amazon, and Marvel technologies, and underweights in Apple, Microsoft, and Broadcom. We can switch the perspective from sectors to factors, and there what we can look at is simply the equity factors over time of the current portfolio. Now, what we do see is that there's a slight positive beta to the value factor and size factor, and a negative beta to low vol. Somewhat surprising, I mean, the negative beta to low vol we can explain to the overweight in tech stocks. And I think the positive exposure to the value factor and size is explained by consumer discretionary and banks. Banks tend to be cheap. Now, having said that, the factor exposures are very small. And that brings us to a next point, or next question. If this portfolio is created thoughtfully, and the short answer is no. Simply because what we see over here is where we see many portfolios that there is factor offsetting happening. And that simply means that you have a fund, for example, here, the communication fund, that has a negative beta to the value factor. Then we see the consumer staples fund, negative beta to the value factor. Then we have the energy index, and we have a positive beta to the value factor. And effectively, that means this is just exposures that are netting themselves off. And so the beta is also why the betas to the factors were on the low side. Now, most sector specialists don't care, but from a financial perspective, factors trump sectors pretty much any day. And having a portfolio of opposing factor exposures simply means that you have, again, market beta, but of course, you're paying a high price for that. And that brings it actually to the cost of this portfolio, right? The cost of this portfolio is 60 basis points. And we can, we can evaluate if we can reduce this. And so we can see if we can replace these funds with passive benchmarks. And the short answer is yes. So for example, we can look at that fund from Fidelity, the Fidelity Advisor Consumer Discretionary, which is charging 74 basis points. Versus another product from Fidelity is, well, Consumer Discretionary Index is charging 8 basis points, and so on. Which effectively means we can reduce the fees from 60 basis points to 8 basis points. Now, as you can see here, it kind of almost looks like it was worth paying those fees, right? So I'll leave that up to the investor, right? But if you do want to have the same portfolio at a much lower cost, right, you can easily do that. Final question is, can we simplify this portfolio? As mentioned, we already highlighted that there's factor offsetting going on, right? So is there like a way to go from 11 securities to something more manageable? Frankly speaking, if you look at positions like in this MSCI Real Estate Index of 1.2%, this doesn't move the needle. It's just a distraction. Same with 1.8%, unless this is a very specific diversifying alternative strategy, right? Such small positions don't matter. And for clarity of mind, it's better to get rid of them. Going back to simplification, indeed, we can simplify the portfolio into 3 securities, which is the Fidelity MSCI Technology Index, the iShares World 3000, and the Fidelity MSCI Consumer Discretionary Index. Now, that would bring the fees from 60 basis points to 15 basis points. And what you can see here, again, the portfolio did better. So you can say, hey, look, it was worth having 11 securities, right? But it's worth recalling, right, the point that we made initially, that this is a portfolio that is constructed, well, as of pretty much today, right? And that there's a bit of performance chasing going on, right? Because as we saw from the track record, that looks far less favorable. And this concludes our short review of Fidelity's sector equity business cycle. So as mentioned, this is 11 securities. From our perspective, you should be consulting those positions, try to have clear effect exposures, and not try to have a little bit of everything, because you're just back at market beta, but at 60 basis points. And that's, of course, the other conclusion. You can reduce the cost for this portfolio from 60 basis points to 8 basis points if you want, right? But then, if you would follow this model, right, be aware that historically, right, this strategy has not done so well, which is kind of disappointing for a firm that is known for its sector expertise. Hope that helps. Have a nice day.